The Income Tax Act 2025. Today is day 41, and I'm studying various provisions relating to the clubbing of income. So, clubbing of income, it happens when people have an intention to reduce their tax liability, and how they plan to do it. They decide to transfer some right to receive income to any other person, maybe their spouse, maybe their minor children, or maybe any other person. So they do this in order to avoid the incidence of income in their own hands. But this clubbing of income provisions covers these cases and does not let them have the benefit of such transfer of right to receive income, and it clubs the income into the hands of such transferor. And there are various cases and provisions which we'll study one by one, starting with section 96, income transfer without transfer of asset. It means when a person transfers the right to receive income without transferring the asset to any other person, then such income is taxable in the hands of transferor. For example, a person, Mr. BB, has an FD with HDFC Bank. It is in his name only, but he transfers the right to receive interest on such FD to some other person. Maybe he transfers it to some kid for his educational help, but it does not mean this interest amount will not be taxed in the hands of Mr. BB. It will still be taxed in the hands of Mr. BB, whatever the intention is, because he transferred only the income, not the asset. The FT is still in the name of Mr. BB. Then comes section 97, income in case of revocable transfer of assets. It says that when a transfer is revocable, then clubbing applies. Means if we transfer an asset to someone with a condition that we can take it back anytime we want, or we can take back the income anytime we want, then it's called revocable transfer of asset or income. In this case, clubbing applies because it is clearly with a malified intention. Then there is a case of irrevocable transfers. In this case, we completely transfer the assets. In that case, there will be no clubbing. And there is another case when there is revocable after death of transferee or beneficiary. If we transfer the asset to any person with the condition that it will become revocable only after the death of the beneficiary, in that case, again, there will be no clubbing. But once the transferee dies and the transfer becomes revocable, means we get the right to revoke the transfer now, then the clubbing will apply. Then section 99, clubbing provisions in case of spouse, minor children, sons, wife, extra. So starting with the income of minor child. If a minor child income of a minor child is taxable in the hand of parent whose income is more. Before clubbing minor's income, we'll check the income of both the parents and see who is earning more other than the income of minor. Then we'll club the income of minor in the hands of parent. But there are three cases where minor's income will not be clubbed in the hands of parent. The minor itself will be taxable or will be liable to taxes for such income. These cases are in case the minor is earning the income due to manual work, or he is earning due to skill or talent. Example, Vaibhav Suryavanshi, he is a cricketer. Everything he earns, it is because of his talent only. Or he is a minor suffering from disability. This is a relief given to disabled children so that they can have some income without worrying about clubbing or the other things. It's kind of to encourage parents to have transfer some income to the disabled children. And then there is an exemption given to the parents. When income of minor is clubbed in the hands of parents, they will get an exemption of rupees 1500 per annum per child on such income. This will be on every child they have. More than two is also allowed. So however, how it doesn't matter how many children they have, their income, when their income will be clubbed in the hands of parents, they will get an exemption of rupees 1500 per annum per child. But this is not available if the SSC opts for new regime under section 2021. Then once the minor's income is clubbed with one parent, it will continue to be clubbed with that parent only unless AO decides otherwise. Where there is a and in case of a divorce between the parents, the parent who maintains the minor child will add the minor child's income to that parent only. Clubbing provisions are attracted even in respect of minor married daughter, means we'll still club the income of minor married daughter in the hands of parents only. Then child also includes a stepchild or an adopted child. This adopted means the adopted by way of properly registering the child, not just saying that he is my child. Then there is income of major child. Once a child is major, his income is not clubbed. He becomes a taxable person himself, so it's not clubbed in the hands of parents. Then there is this case of accretion income, when a minor is earning some money using his skill or talent, but then that money he earns some further income for which skill or talent is not involved. That extra income is clubbed in the hands of parents. I have this example here. Okay, let me just say there is an example, as I said earlier, about Vaibhav Suryavanshi. He is a cricketer. He is using his skill and talent to earn money, and let's assume he earned rupees 10 crore in his IPL contract. This 10 crore will not be clubbed in the hands of his parents because it is his income earned by his skill and his talent. But then he decides to deposit this 10 crore rupees in an FD. The interest he will earn on that FD, let's assume rupees 1 crore. This 1 crore will be clubbed in the hands of his parents because that's not an income he earns from his skill, and it is a provision of the law that accretion income will be clubbed in the hands of the parents only. That's all about minor child. Then we have the case of spouse. When an asset is transferred to the spouse without adequate consideration, or except for an agreement to live apart, then it's clubbed in the hands of a transfer. What happens usually is people try to transfer some asset to their spouse so that they don't have to pay taxes on such asset, but here this section disallows it and makes the income taxable in the hands of transferor only. But there are two exceptions. Firstly, if the asset is transferred with adequate consideration, means we transferred the whatever it is, house, property, or something, at the stamp duty value, at the fair market value, then we don't need to club the income of the spouse in the hands of transferor. And in case of agreement to live apart, again they are considered as separate people. Then there's a case asset is transferred to a third party without adequate consideration, but it is transferred for the benefit of the spouse. Then again, clubbing will be hands in the hands of the transferor. We transfer to some other person, maybe some person, and then we say the income you earn from that asset, you will give that income to our spouse. In that case, also the income of the spouse will be clubbed in the hands of transferor only. There are some conditions for this. Firstly, there is the relationship of husband and wife should exist at both first the time of transfer of asset and then the time of generation of income. At both the times, the relation of husband and wife should exist. Then there's a case if a property is transferred by individual to his spouse or minor child, then that individual is treated as the deemed owner of such property, except for in case of a minor married daughter. I have an example regarding this. Where is it? There's a case when, if we have a, let's assume we have a house property and we transfer it to our minor married daughter, then it is not deemed as the transferor is not deemed to be the owner of such house property, but for the purpose of computing income, it will still be clubbed in the hands of the transferor only. But this is the case of minor married daughter. But otherwise, when we transfer it to our spouse or our child, then the individual who transferred the asset is treated as the deemed owner of such asset, and income is automatically calculated in his income only. Now, if the minor married daughter, if the daughter is not a minor, if she is just a married daughter and we transfer such asset, then the individual is neither treated as a deemed owner of such property, and the income is also not clubbed in the hands of the transferor. Moving on, then there is a case of spouse where the transferor has substantial interest. This is the case where we have some substantial interest in a business or company or something, and then we get our spouse appointed as an employee in that concern, and she earns or and our spouse earns some remuneration from that business without having the adequate skill or knowledge. In that case, it is simply a case of tax evasion, so it is clubbed in the hands of the person who has substantial interest in that firm, means the spouse who got the other spouse into the other firm. Income should be by nature of salary, commission, bonus, remuneration. Such remuneration should be received from a concern where the SSE has substantial interest. When he has substantial interest, he automatically is assumed to have some kind of a control over the firm and some kind of a incentive to protect the firm from paying taxes, extra taxes. So this is the case of substantial interest if there is an SSE or his relative. Relative includes sister, mother, father, brother, sister, spouse, legal ascendant, lineal descendant. If they have a substantial interest in any company, firm, AOP, BOI, and that business is paying remuneration to the spouse, that remuneration will be clubbed in the hands of the SSE only. Substantial interest means 20% or more shareholding or 20% or more profit sharing ratio. Now, if remuneration is solely attributable to the technical and professional qualification, knowledge, experience, then the provision is not applicable. Means, if the spouse has the required knowledge and required qualification not in terms of degrees, but qualification in terms of being able to do the job that is required, then the clubbing is not done because it's actually earned from their own hard work. Like in this question number 9, there was a case where a person was a fashion designer and his spouse was the model for such fashion designing company, and they were paying that person for modeling for the company. In that case, the modeling was the technical and professional qualification of the spouse, so her income was not included in the income of the spouse who owned the fashion company. Where both husband and wife have substantial interest and both are in receipt of income by way of remuneration, then the income will be clubbed in the hands of that spouse more total income exceeding such who has total income more who has a more income excluding such income, means the spouse who has income otherwise from this source. This is the case where both husband and wife have a substantial interest in the concern and both are receiving remuneration from that concern. The question arises, in whose hands will we club such income? The income, it says that the income will be clubbed in the hands of such assessee who is earning more without considering such income from such concern. The spouse earning more income will add it into his hands only. Now, in case the only source of income for both the spouses this concern only, then it depends on the AO. He will decide who in whose hands will add this income. When any such income is included in the income of either spouse, income arising, then in the following succeeding years will also continue to include such income in the spouse only. Once we do it, so there are some notes which we need to consider. This example. This is regarding Mr. BB gave a gift of rupees 10 lakh to Mrs. BB. Okay, this is about accretion income. We'll come to it after a bit. Income of son's wife from assets transferred. Assets transferred to son's wife without adequate consideration will be clubbed in the hands of transferor. Means the daughter-in-law, if you transfer some assets to the daughter-in-law, that income from such asset will be clubbed in the hands of transferor only. Same is the case if we choose an indirect part to do the same, means we transfer it to some third party for the benefit of our daughter-in-law, then again the income will be clubbed in the hands of transferor only. Again, the relationship of mother or father-in-law and daughter-in-law should exist both at the time of transfer of asset and at the time of generating of income. Then there is a case of transfer of asset to HUF. It says that when an individual transfers any asset to HUF, the income from such asset will be taxable in the hands of transferor only. Even though it's the HUF who is receiving the income, but it will still be taxable in the hands of transferor only. And then when the partition of such HUF happens, the uh, and such asset is distributed among various members, we will consider the asset that has been received by the spouse of such individual, and will club the income of of his spouse in his hands, in the hands of transferor. Means, like, this is an HUF. It has various members. Firstly, the individual himself, then his spouse, then maybe his father, and maybe his mother. These are all the members of this HUF. When the asset was transferred to this HUF, the whole of income was taxable in the hands of transferor only. But after partition of the HUF, the income, firstly, the income earned by the asset which belongs to the individual will be taxable in the hands of individual only. We'll also club the income of spouse which it has earned from such asset. But the part of asset received by father and mother from such partition, it will not be taxable in the hands of individual. They will themselves pay taxes on such income. Then there are some further notes about this. Income includes loss as well, which means in case there is loss, then losses are also clubbed the same way we clubbed the incomes. Where asset is converted in any other form, income derived from such converted asset is also clubbed. Again, it's trying to fool the system, so a provision is made there to prevent it. Then there is a judgment about natural love and affection. It is considered as a good consideration, but it is not an adequate consideration in the eyes of law. And if asset is sold by the transferee, then capital gain is treated as income and shall be clubbed. This is the same case when it doesn't matter in what head you are earning the income. Every income is clubbed in the hands of transferor when clubbing applies. So this is the case of capital gains when the transferee is selling that asset. Again, the capital gain will also be clubbed normally as any other income would have been. Then there is the case of cross gifts. It is a case when there are two transactions and they are so closely connected with each other that they seem to be a single transaction, and it is kind of a device used for evasion of tax only and nothing else. Like this example, Mr. X, he has a brother, Mr. Y, and these are their spouses, Mrs. X and Mrs. Y. Now, Mr. X is paying rupees 12 lakh to the wife of his brother, and Mr. Y is paying 8 lakhs to the wife of Mr. X. So, this is clearly nothing but an attempt to evade tax. Therefore, this provision is there for cross gifters, and it makes the income taxable in the hands of the transferors only. So, like in this example, he transfers 12 lakhs to Mr. Y, Mrs. Y. The income earned by Mrs. Y on such 12 lakhs will only be clubbed in the hands of Mr. Y only. And again, the income earned by Mrs. X on 8 lakhs received from the brother of her spouse will be clubbed in the hands of her spouse only. But there is one thing we need to note, that this clubbing will be restricted to the amount common, which means he's transferring 12 lakh and Mr. Y is transferring 8 lakhs only. So we'll club only up to 8 lakh rupees, income earned on asset up to 8 lakh rupees only. Like in this example, the total income of Mrs. Y is 72,000, but we are only clubbing 48,000, which is the proportionate amount. 72,000 multiplied by 8 lakh divided by 12 lakh. We only calculate up to the extent of mutual, the amount which is common between the both, which is 8 lakh in this example. There is another example regarding the same. Mr. Madhav gave 10 lakh rupees as gift to the wife of his brother, Mr. B, and she invested it in an FD having 9% rate of interest and earned 90,000 rupees. Similarly, Mr. B also gave 7 lakh to Mrs. Madhav, who invested it in 10% debentures and earned an interest of 58,333. So again, the income will be clubbed only up to the extent it is only up to the extent that of the matching amount, means 7 lakh only, because 7 lakh is the matching amount and 3 lakh is excess amount that will not be clubbed. So in this case, Mrs. B is earning 90,000, which is on the excess amount 10 lakh. Will restrict it to income on only 7 lakh, 7 lakh only. So we'll take the proportionate amount 90,000 into 7 lakh divided by 63,000, and only 63,000 will be clubbed in the hands of Mr. B. Moving on to the next points. When any asset is transferred by an individual to his spouse or son's wife, and such amount is invested in the business, then proportionate profit of such business shall be clubbed. So again, the case we are trying to run the business, but in the name of spouse or son's wife. Again, this income is clubbed in the hands of transferor. But there is one condition, an important condition, that the amount gifted should be included in opening capital. Then only it will be clubbed. If it's not, it will not be clubbed. Like I have this example here. Mr. BB gave a gift of rupees 2 lakh on April 19, 2026 to Mrs. BB. This is Mrs. BB's business. On 1st April 2026, she had a capital of 5 lakh rupees, and then later on in April, she received further 2 lakh rupees. So the opening capital does not have any contribution for from Mr. BB. So in this case, the entire profit of 3 lakh which it has earned during the year will be taxable in the hands of Mrs. BB only. But in the next year, the closing capital includes the amount received from Mr. BB as gift, which is 2 lakh rupees. Therefore, the income earned in next year, like in this example, is 4 lakh rupees. It will be split among Mr. BB and Mrs. BB in the proportion of the contribution to the capital. 4 lakh rupees. Total opening capital is 10 lakh rupees multiplied by the share of Mr. BB 2 lakh rupees. It will be clubbed in the hand of Mr. BB, and rest of it will go in the hands of Mrs. BB only. Then this is the case of second generation income. Any clubbing provisions will not be applicable to second generation income. It is supported by this case law CIT versus MSS Rajan 2001 Madras High Court. An example of it was here. Mr. BB gave 10 lakh as gift to Mrs. BB, who put it in an FD of rupees 10 lakh at 10% and then earned an interest of rupees 1 lakh on it. This 1 lakh is clearly clubbed in the hands of Mr. BB. But then the amount of interest increases next year because it's paid on principal as well as interest amount 11 lakh rupees at 10%. She receives an interest of rupees 1 lakh 10,000 next year. Out of this 1 lakh 10,000, only 1 lakh will be clubbed in the hands of BB, and rupees 10,000, which is earned on this interest income, which has already been clubbed in the hands of Mr. BB. This will not be clubbed in the hands of Mr. BB again, and it will be taxable in the hands of Mrs. BB only. Then there is a last provision which says the liability of person in respect of income included in another person. So it says that AO can serve a notice on another person, means the transferee to pay the tax levied on the SSC due to clubbing. And there's a provision also that they are held jointly, both jointly and severally liable to pay tax, both the transferor and transferee.